Hello and welcome to ESGX Live, the community for education, inspiration and action, with Paul Herman in San Francisco and me, Nigel Lake, here in New York. This is our second special event marking Earth Week, and indeed it's Earth Day today in the Americas and Africa and Europe. Tomorrow we have an event about global religions and faith-based investing, and then the following day, Friday, in Americas, etc. And this will be Saturday morning in Australia and the Asia Pacific. We have a discussion activating academia for climate change action and more. I think those are both going to be fascinating discussions. So if you haven't signed up to join us live, then please register by visiting register.esgx.org. Now, with that bit of advertorial out of the way, let me talk very briefly about what has happened since 1970, obviously 50 years ago today. So this is just an image from that day, all those days ago, and it's interesting to reflect on what has happened. In 1971, and this is on the next slide, the Club of Rome commissioned a report or some work by some very smart people from MIT to build a model which was the first computer model of the world as a closed ecosystem. And what you can see in the background here, that the black background with the letters on it, was how the output from that model was produced as a effectively wide paper printed output, because there were no printers that could render graphs like that. And then they went on to write a book called Limits to Growth, which many of you may know, which explained that if we lived in a closed system, eventually as a population, we would come up against limits to growth, reflecting the fact that we were in an ecosystem with limited resources and where we are not taking account of some of those limited resources and how we make decisions. They wrote another book 20 years later, and another book 30 years later. And then in 2012, Jorgen Randers, one of the original authors, wrote another book called 2052, which reviewed what had happened in the last 40 years and set out a new model for the next 40 years. And of course, in all of this, there has been a lot of talk and not necessarily very much action in the real world to drive change. And if we just flip forward, Paul, along the way, I happened to meet Jorgen Randers at a course run by the Cambridge University Institute for Sustainability Leadership. And I walked away from that course with the idea that decision-making in business was just thoroughly broken because it was horribly short-term in nature. And so I wrote my own book, possibly not quite as impactful as Jorgen and his colleagues. And at the launch of that book, which is what this picture is, I had a fascinating discussion, which was, should companies be focusing on making things and making products and services, or should they be thinking about their role as actually creating good quality employment? Now, this was 5 or 6 years ago, and if we wind the clock forward to today, obviously an awful lot has changed. What was born out of that, and if we again just flip forward, Paul, onto the following page, was some work I did with Jorgen over the last couple of years, and we wrote a paper called The Future of Society, which distilled and built on what had been done before to say there is a simple equation, if you like, for what we need to live a happy and fulfilled life, which is people need employment to give them income and also some sense of self-worth and satisfaction, and we need some sort of safety net to provide for everything else, and that needs to meet our requirements for housing and basic sustenance and transport and healthcare and education. And if we got all that right, then perhaps we would have economic equity, and we would have environmental equity, and we would have happy people. And then just on the last page here, Paul, of the setup for this, we drew out of this, what were 8 things which we could do that could in practice really help drive some of this change. And these are quite broad ideas, and there are different ways individual ones of these can be achieved. And what is interesting to reflect on as we go into the discussion today, where we will probably talk about modern monetary theory and a whole host of other things, is that many governments who have been deeply skeptical about some of these ideas, and indeed about modern monetary theory itself, have piled in and started to implement some of them, which is slightly ironic perhaps, but is driven by the circumstances that we find ourselves in. So with that as some context or some ideas at the beginning of this discussion, I'm delighted to hand over to Paul Herman in San Francisco to lead us on through the rest of the three fantastic speakers we've got today.
Great, thank you, Nigel, and welcome everybody to ESGX. So good morning in Australia, Asia, Pacific, good afternoon in the Americas, and good evening in Africa and Europe. We're delighted this week as part of Earth Week. This is our second of 4 events this week. This is on green jobs, the launch of the new Green Jobs Report with Scott Fullwiler and his team at UMKC and the Global Institute for Sustainable Prosperity in conjunction with HIP Investor, to the Green New Deal, which will be presented by Dr. Fadel Kaboub of Denison University and president of the Global Institute for Sustainable Prosperity. And then the Job Guarantee by Dr. Pavlina Chernova. And so we have a really action-oriented, inspirational, and educational session today. So Dr. Scott Fullwiler is an associate professor at the University of Missouri, Kansas City, one of the homes of modern monetary theory. Dr. Fadel and Dr. Pavlina also are associated with modern monetary theory as well. So you'll see that throughout our conversation. So I will be helping drive the slides and facilitate the conversation today. Remember, this is also, please put your questions in the chat box and the Q&A, and Nick and Nigel will help facilitate those. In addition, some of Scott's prospective PhDs at University of Missouri, Kansas City will join the conversation early on. And this is also being simulcast into YouTube as well. So if you find this interesting, share this with your friends. Conversation is being recorded and the slides will be available afterwards. So the kickoff is the Green New Jobs Report. This is something that many of us on this call conceived of several years ago and are delighted that Earth Day 2020 is the formal launch of the report. Scott, while I set up the slides, would you like to turn on your camera and be ready to start our conversation? And if you can unmute.
Shoot. Okay.
I heard that.
I'm trying to get.
Great. If you.
Oh, I see. Okay. I needed somebody to. Okay, I get it now.
Great. So welcome, Scott. You're based in Kansas City.
Yes.
Is Kansas City under quarantine today?
Yes, generally through May. So let's see.
All right, so I can drive the slides here. Tell us what we're going to cover today.
Okay, well, and we should note that this is going to be a collaborative presentation with Paul and myself. Obviously, if we're going to be going through some HIP Investor materials here, and that is quite obviously Paul's wheelhouse there. Let's see. I should also note that sorry, my daughter just walked out the door. Should also note that we have Amir Khalegi, Kyle Moore, Jordan Ayala, who have worked tirelessly on this with us and done a good deal of the number crunching here that goes into this. At any rate, let's see. Why don't we go to the introduction slide and walk through.
Sounds good. And then one more overview is all this work is based on, and you'll describe this along the way, the sources of data are job surveys and the jobs report that we hear about every month. And so we're bringing that to a new level by layering on sustainability.
Right. Okay. Now, for some reason, I don't have this on my screen correctly. Oh, I see. I can move it. That's interesting. Okay. Okay. So the project is a collaborative project with HIP Investor, Global Institute for Sustainable Prosperity, with Fadel Kaboub, who's going to be presenting a little bit later here, and UMKC Economics. The core point that we are attempting, the core goal here is to create a view of the labor market in particular, linking people and planet ratings to official jobs and employment data and beyond, actually, in terms of longer term goals, national, state, county, city levels. For now, today, we are generally looking, well, only looking in this presentation at the national level. We've started to get going on the state level. And then looking ahead, we're looking to put out some important metrics on labor market as it relates to people, planet, prosperity, and the policy implications of those metrics, and then obviously policy advice going forward. So, okay.
Great.
Unless you have something to add, there you go.
Nope, all that sounds good. So
okay, this is your part.
We want to go deep. So as Scott introduced, we're taking the data available from the Bureau of Labor Statistics and other surveys that are done on a monthly basis. And these have a lag from anywhere from 1 to 3 months of the official job, high-level job numbers that come out. So the concept is, since those don't appropriately yet assess how sustainable jobs, companies, and industries are, we've taken the HIP rating system of 8,000 corporations globally, covers the 95% of the jobs, 95+% of the jobs that are being tracked by the government. And this 0 to 100 rating system is 100 you can think of as closer to utopia and 0 closer to dystopia. And so we want to live in a more regenerative and sustainable society. And so the breakpoint for this in the middle is 50. So 50 and above is net positive for people, planet, and trust. And 49 and below is net negative for people, planet, and trust. And what we found over time is that the more sustainable companies generally can be, have the potential to be more profitable and better for your portfolio. And so we're going to talk about in the jobs report today are 3 elements. One is, what are the products and services that companies make? And we've done a high-level analysis of more than 100 industries as to whether that's net positive or net negative. We've also looked at the operating metrics of a company, including the earth metrics, energy, water, waste, and emissions. And you'll see that view. And then we have an overall view that encompasses not only environmental characteristics, but people characteristics. And so that'll be the overall HIP score. So you'll see 0 to 100 scores on overall sustainability, on the earth metrics, and on products and services. And just so you know, this is a bottom-up, data-rich approach. We collect more than 1.4 million data points yearly on 8,000 global companies. And those roll up into metrics, which roll up into these pillars, like the earth pillar, which roll up into the overall rating. And so this model of measuring sustainability of people, planet, and trust, which you see in these middle pillars here, we're going to focus on these 3 today: the products and services, what companies make and deliver, the earth rating, and the overall HIP rating. And if you want to know more details, you can learn more in the HIP Investor book, which is available in a print book, ebook, and audiobook. All right, so Scott, tell us how that shakes out when you overlay that type of sustainability methodology onto industries.
Okay, well, yeah, you essentially said it there. So what we've done is link the HIP investor ratings to the industry codes. For now, we are within the establishment survey, which is used monthly by the Bureau of Labor Statistics to put out the jobs numbers, how many jobs were created last month, et cetera. When you see that come out early every month, there's about 180 industries, and a lot of them are listed on the bottom there, but of course the Excel couldn't fit all 180. But then what you see at the top of your screen is the ratings, the HIP ratings for products and services by quartile there. So you can see, and they're declining. So you've got 75 to 100 on the left, 50 to 75, and then 25 to 50 and 0 to 25 on the far right. And Paul, I missed it. Did you talk about the 50?
We did. 50 and above is generally net positive.
Right.
And so here are examples of some of those industries above 50 with sample companies.
Right. So, yeah, so the industries that had the highest scores there and how much each one of them employs, we've got some sample companies, as Paul noted, and sort of the key takeaway here from this, most companies do make and sell products and services that are net good for people, planet, society. If you want more of the details of what's going on within that, that's Paul's area. So we'll see what questions we get. Anyway, on the other end, we have the particularly extractive industries here, and a number of companies there to give you examples. And then their HIP score for their products, obviously quite a bit lower in the single digits. And so then if we move on to the Earth score, sorry, this whole thing isn't showing up in my screen, so I have to move things around. Now, if we go to the Earth score, so this is a score. Well, Paul, you want to hit what is in that score? There's a number of things going on.
Yeah, so there's 4 major metrics: energy, water, waste, and emissions. And you see the majority of industries below 25 and below 50 for 2 reasons. One, half the companies that are publicly listed don't even report any of these metrics. And the other half, the majority of them, don't report all of them, or are not doing that great, or have high emissions, high water consumption, high waste production. So there's a very narrow band of industries that have any meaningful contribution to environmental performance. And so
Paul,
some of those
there's one good question here which just came off the Q&A, which is, what kind of water companies are net positive whilst you're talking about water? Is that something you can comment on?
Yeah, so these water companies that are captured here, things like water equipment, water filters. There's actually a whole exchange traded fund, mutual fund of water companies that help produce sensors, equipment, filters that keep water clean, allow us to regenerate water, like in some of the clean toilets, or processing water from wastewater so that it can be reused.
So here we see the top 3 scoring industries, and as we can see, the top score is 67. That's the only one in the 60s. So out of all of those industries, there's a long way for all of them to go in terms of environmental performance and the environmental metrics in the HIP score. When we move to and then of course, there are a number of companies that we could put zeros to. Again, as Paul said, partly because of performance, partly because of not reporting. And now if we go to the overall HIP score, meaning now we've integrated the products and services score, the Earth score, as well as the other, well, there's 5 other scores that go into it. We see something that looks, well, okay. We have no companies in the 75 to 100, well, no industries, sorry, in the 75 to 100. There are companies in the 75 to 100, but if we average that across the entire industry, we don't have any industries over 7,500 or over 75. And you can see the bulk of them between 25 and 50. Okay, why don't we move to next one? Okay, so again, as it says, there's some, but not enough companies are net positive overall. And yeah, majority of companies, opaque, extractive. So not transparent and not net contributors to people, planet, and trust.
Yeah, and just to chime in about bottled water, the bottled water is not in the high rated category. It's in a beverage delivery and beverage manufacturing, so much lower
You want to
score.
address the question about publicly traded securities?
Yeah, and then there's a question here about publicly traded securities. So HIP covers 8,000 global equities. It's about 2,300 in the US. There's about 2,400 in the Russell 3000. So the Russell 3000 is not 3,000 companies, it's less. And so we produce and license these ratings for investors, advisors, fund managers, hedge funds, 401k plans. And so then this gets built into the investment decision-making process of those clients that we work with. All right, so, time for the reveal, Scott. So now we take this sustainability and we layer this on. This is coming from the February 2020 jobs.
Yes, February 2020. So next month, of course, is going to be quite interesting when we get the March data. But now we have our snapshot of before COVID happened and what was going on. So what we're doing here is we're looking at employment by those four quartiles. So we've got the products and services here on the lower left. I'm going to lay these out slowly so you get an idea of the snapshot that's coming or how the layout looks. So on the HIP score, the HIP Earth score, we have about 109, 110 million employees in the industries that are rated 0 to 25. If we go over products and services, you can see it's in the 50 to 100 range. And then overall HIP score, again, most of them are falling in the 25 to 50 range. So again, we've got some key takeaways in the comment boxes there. Most jobs deliver good products and services, but they nearly all have negative or unclear eco impact and are with firms that rate net negative and extractive and non-transparent.
So the good news is we make products and services
Right.
that are generally good for people, but we don't know, we at least don't know, and in many cases aren't doing that well on the environment. And then when you bake in what people get paid or how they're treated or the diversity of companies, the majority of those industry averages are net negative. So,
right.
Okay, so tell us about, so that's on employment. How about on weekly hours?
Oh, this is hours. Okay. One of the key things that pops up here is if you look at the lower left, the products and services scores, remember there's only about 1 million employees in that 0 to 25 bucket. And most of them are, well, quite a few of them are oil, gas, coal, and so forth. And it was interesting to us to see that on average, the average employee there is working, nearly working overtime. So you get into a number of service industries as you get 25 to 75. And so you've got more part-time work going on there. So
there was one question on this early on, actually, from Jennifer, which she was commenting about being interested in to what extent this reflects the nature of work that's being done, to what extent are these businesses doing more activity that involves caring, creative tasks or roles which have an essential human element, and indeed then which won't get automated later on.
Yeah, great question, Nigel. I mean, one view is where those jobs, where that service or that product is positive, that's actually showing up in the bottom left of this chart. So the majority of jobs are delivering that. But in the business that wraps around those products and services and in the environmental extraction and processing and usage, there are gaps. And so I think what Jennifer's alluding to, which will be part of this whole conversation, especially when we get to the Green New Deal and the job guarantee, is how can we create incentives for those more sustainable jobs, for companies to create those more sustainable jobs, maybe for tax policy, how people get paid for those jobs, and how do we remove the subsidies for some of those extractive jobs? Scott, anything you want to add to that?
As Peter Drucker said famously, what isn't measured isn't managed. And so part of this is coming up with those measures so we can manage it better. There are a couple of good questions there. I don't know if you want to.
Yeah, I'll just quickly answer those. Large corporations that are in multiple business units like Johnson & Johnson or United Technologies, which now merged with Raytheon, we blend based on the revenue of each of those business units. We blend their participation in those different industries together. So to the extent companies report revenue on the different industries they're in, it's blended in. But some companies don't report that level, and so they have a primary industry, and that's where they're reported.
Yeah.
There's a second question about why companies, how can they encourage investment to be environmentally sustainable? I think this is why we're seeing green bonds now. Green bonds issued by companies like Apple or Starbucks or Toyota allocate those funds to some of those sustainable activities. But it's still the case where the majority of information about energy, water, waste, and emissions are not meticulously tracked, reported, or even shared with investors the way that financials are.
Right. Question there about why companies don't report. I suppose some of it is because they're not required to, and some of it is because investors haven't pushed them to. And well, you can speak to other things there, but there's in some areas working on standardizing metrics still and so forth. So.
All right, so we covered jobs and hours. How about pay? Who's getting paid more, Scott?
Yeah, so this was one of the interesting things that we saw is that if we look at the HIP overall scores and we look at the HIP Earth scores, there tends to be some improvement in pay if you are working in an industry that has a higher HIP score. Recall that on the products and services that over there on the far left in the red, again, we're talking about less than 1% of the jobs in those very extractive industries. But as we know, those engineering positions and so forth tend to pay fairly well. But as we're seeing here, greener jobs are there is some indication that they're paying more per hour.
All right, and so then when you take the hours times the pay, you end up with the weekly earnings. So what's happening with the weekly earnings?
And we see a similar pattern here. Again, remember that that lower left one there is less than 1% of the jobs, and let's see.
So you're saying that red segment of the products and services is only 1% of the jobs?
Yes.
Okay, but those jobs right now are either higher paid by hourly wage or by hours when you combine them together.
Of course, if we set up an economy designed to run on fossil fuels, if you are one of those people skilled at extracting the fossil fuels, you probably will get paid fairly well. That's what we're seeing here. Okay, so some takeaways.
What are the takeaways?
Yeah, so again, early on here in the slide, we're repeating some things you've already seen. Most industries and jobs are net positive. And a lot of those are services, and there are some positive products in terms of their products and services HIP score. But at the same time, nearly all jobs with firms that are Earth negative. A lot of it is because they do not report, including many more with, they might have sustainable products and services, but they aren't reporting it. The overall HIP ratings, we're seeing some indication that it's the higher the score, the higher that there's a trend towards higher pay. Again, at the same time, nearly all of these lack transparency. And the industry HIP scores are still not as good as we would want them to be. In other words, a lot of room for improvement, and most jobs are in those industries where there is a lot of room for improvement.
So Scott, and this might be Amir or you, there's a question on how are wages determined? It seems difficult across different companies and industries. The wages, like how are we able to roll up these
this is the
hourly wages.
This is the official government survey of business establishments. So I don't know the exact process that they go through in the survey. On the other survey, on the unemployment survey, which we'll get to next, we have gone into the inner details of that. For this particular project, most of the last few months was spent linking the industry codes with the HIP scores and getting those to talk to each other. And that was quite a bit of work. Now that we've got that part settled, we will be able to move on into more of those inner workings of things like that.
Great. All right, so what's next on jobs, and then we'll get to unemployment.
Right, so what we've got here, we've got we're covering for the moment 90% of private employment in these rankings. We'll move to 100% coverage plus government jobs. The government jobs have their own sort of challenges in putting those together. We also will segment out, split up supervisory and non-supervisory. And there are other surveys that we will start to use to complement what we have here. The establishment survey is a very important survey, but it's not the be all end all. And so we will begin to integrate more things there. The HIP products and services, there's products, there's services. Those are different, obviously, and it's people and planet. And so we're going to work on getting at the components of that and linking that with industries. And then as we move into state, county, city, etc., we will begin to use the HIP municipal bond ratings to give us an idea of ratings for those locations. And Paul, we didn't have you talk that much about that. But let me finish this last line and then you can do that. So then ultimately we're going to begin to publish a report and online and to go with these presentations. Then there will be a written publication that you can obviously see the figures and so forth and download those.
Sure. All right, so let's wrap up this section with this slide. This is one of my favorites to use this in every presentation.
Yeah, that one's famous, isn't it?
Yeah. Yeah, so what if it's a hoax and we created a better world for nothing? Right. I do want to bridge this to one of the questions that was just asked, because you can see sustainability and livable cities and renewables and healthy children.
Right.
And so sustainability sort of has this wide berth definition currently. At one sense, we have some positive intentional companies, even those that are large multinationals like Unilever and Novo Nordisk and Stanley Black & Decker even, who've set greenhouse gas reduction targets of 100% by 2030. And then you have half to 3/4 of companies that are not yet even reporting to Carbon Disclosure Project or to with sustainable accounting metrics. So more and more investors are putting pressure on this, what's called ESG, environmental social governance. In the best case, we're going to get to this net positive world and get there quickly. But the training of people inside companies has not yet included the training that some of you in the audience have had, let's say at the Presidio Graduate School for Sustainability MBA, or the engineering mentality that comes along with tracking water, energy, and waste. So, all right, so that's the Green Jobs Report. That's the new launch. Very exciting for Earth Day 2020. So Scott, we have about 12 minutes to cover unemployment. So I'll swap over to there. And And then we'll get into the Green New Deal with Fadil and the job guarantee with Pavlina.
Right. Okay, and we may be able to have Kyle and Jordan answer the questions when they come up if they want to. Given time,
well,
I probably won't. I probably won't
your
look to those.
audio and video. So what are we going to cover in the next 10 to 12 minutes, Scott?
Okay. Oh, did you not hear what I was saying there?
No.
That was not okay. We might be able to get Kyle and Jordan to answer questions.
Great.
Given time, I probably won't look at the questions for about the next 10 minutes. So
okay.
Maybe typing their answers or whatever. So
yeah.
Anyway, okay, so we're going to walk through. This is something we've been working on at UMKC with Jordan and Kyle and Jacob Powell as well for a few years now, which is an alternative indicator of unemployment. And this is also, again, in collaboration with the Global Institute for Sustainable Prosperity. So there's the outline. In the interest of time, maybe we'll just roll with it.
Okay.
Yeah, go ahead. The next slide.
So are there enough jobs, or were there enough jobs until 2 months ago?
So this slide is showing you how many people are officially unemployed. I'm going to go with the green line first. How many people are officially unemployed for every job opening? And there's a survey of a job opening survey that comes out monthly as well that we're using here called the JOLT. Some of you may be familiar with it. Anyway, somewhere in the middle of 2018, for the first time, the number of officially unemployed fell below the number of job openings. Now that doesn't account for geographical differences, skill differences, things like that. So to some degree, it might be apples to potatoes in that case. But at the very least, up until about 2 years ago, we had never had a situation where those who are considered officially unemployed had as many jobs openings as their numbers. But that's not the full part of the story. There's also, as we know, there's people who are involuntary part-time, which means they'd like to work more, but there isn't work available for them. There's also people that are marginally attached. They may not have looked in the last month, and so they don't even get counted as unemployed. And given that the history is that there's not enough jobs for people who want jobs, it's a significant bias in the way that we count the unemployed, that we don't count them if they didn't look for jobs that don't exist. And so this red line is showing you, if we include those folks, we're at 1.69 as of February. Note that that's the lowest that we'd ever been. So basically, there are not enough jobs for the people that want jobs. And that's the normal case. Okay. Next. So who gets the jobs? So what we've got here is flows of people from the non-employment categories, and we just grabbed sort of the main three here, from the non-employment categories into employment. And here we're just looking at full-time employment, into full-time employment. So what we see here, the reason why I want to show you this is the green line there at the bottom. That's the officially unemployed. That is, that's the group of people who are officially unemployed that get jobs. Okay, and notice first off, those flows actually don't have much to do with the business cycle. They're not going up and down with the economy. They're actually fairly constant, although they've been dropping a bit since the middle of the last decade. Anyway, then we also have that blue line. Those are people that in this survey are saying they are not working and they don't want a job. And yet, lo and behold, next month, they end up with a job. They end up working full time. And more of those people are getting jobs than the people who are officially unemployed. And then we can see also the red line, the people who are involuntary part-time are also getting those full-time jobs. Obviously, full-time jobs are coming from the people who already have full-time jobs or switching jobs and things like that. But People that are
So
newly
Scott,
into
what do you
the
expect
full-time
these
job.
lines to do in the next month or two? Is
What do I
involuntary
expect
part?
these lines? That's going to be really interesting. Well, maybe in the interest of time, we'll have to leave that one out for now. But there is a slide toward the end that has some predictions for that.
Okay.
But Kyle would be the one I'd ask that question to at any rate. So.
Okay.
Okay, so this just shows the same material you saw in the previous slide, but in percentage terms. And the core thing there is that green space there on the bottom is the officially unemployed. This is who is getting the full-time jobs again from outside of the fully employed. And again, we see fewer than 20% of the jobs, full-time jobs, are coming from employers that are dipping into the officially unemployed. They are again dipping into people who weren't working and said they didn't want to work, and people who are involuntarily part-time. So what we've done is we've put together an indicator that we for now are calling the employment needed indicator. And the point there is employment in terms of jobs. How many jobs would be needed so that everybody who wants to work could have a job? Now, we only have the current population survey that's being used by the Bureau of Labor Statistics. That's sort of the best we can do right now. It's not perfect at all, but from that, I think we've done about the best that's possible. And what we're doing is we're basically taking everyone who either by what they answer in the survey or by their actions has indicated that they want to work. Basically, they've indicated that they want to work. Either they said they did, or their actions indicated that they moved into the next month a category that was either working or was explicitly wanting to work. And so we can see that this also has the properties of going, those shaded areas are recessions, of going up significantly in recessions, which we would expect. And we can see that, again, this goes through February 2020 with the unemployment rate very, very low at 3.5%. We were over 25 million people. Next slide. Now, of those people, the blue line there is telling you how many of them got jobs that same month, over that same month. And the difference between them then, the difference between those two lines is the number of people that wanted jobs and didn't get jobs. Actually, go back real quick. And so the space in February between those two lines was about 17.5 million. The officially unemployed was less than 1/3 that amount. Okay, so the unemployment rate is not a good indicator of who wants jobs. Okay, now, so what we've done is from the previous slide, we simply take the how many people got jobs or found work and divide it by the employment needed. So the two lines in the previous slide. And if we look at this historically, what we can see is, go back, the best we've done is about 31% of the people that want jobs or more work find it. And so this is telling you a much different story from compared to what a 3.5% unemployment rate is or how people interpret that. So even with unemployment at a historical low, we still got to only about 30% of the people that wanted to work finding jobs. Okay, next slide. So this is a projection. The St. Louis Fed came out with some projections of what they think is going to happen, or I guess the best projection they could do in terms of who is going to be affected, layoffs and so forth in March and April. And Kyle and Jordan did some work of taking those estimates and playing around with them and seeing what that would mean for our indicator. And I believe that what has been assumed for this is that the people who get jobs doesn't decline, which, as we know, probably won't happen. But it would fall at any rate to 8.5% and 5% basically, and it'll be generally lower than that because all these people won't get. You won't have the same number of people getting jobs. So this is falling off a cliff, basically.
And that means that instead of 1 in 3 people getting a job, it'll be 1 in 20. Is that right? From 1 in 3 to 1
I
in
can't hear
20?
you.
Okay.
Yeah.
All right. Well,
Okay.
let's wrap it up, and then we can move to the Green
Okay.
New Deal.
Okay, yeah, so what we've done here is we've just added the previous indicator, the number of people who want jobs and haven't found jobs, to the earlier slide, dividing that by job openings, and we're at 2.66. So the best we've ever done basically is 2.66 people who want jobs relative to job openings. Okay, next slide. Okay, so we're going to look at the methodology that we have here, and also enables us to pull out some stratifications in the labor market. So I'm going to give you one example here very quickly. So this is a look at a ratio of people moving from unemployment to employment, or moving from unemployment to moving out of the labor force because they are discouraged or whatever. If you're above 1, and if you're in the blue, then the economy is in a point where more people are moving to employment. If you're below, then you've got a situation where more people are moving out of unemployment to not in the labor force. They don't want a job, they're discouraged or whatever. And we can see, as Kyle reminded us this morning, that that red space there, which we had more people moving out of the labor force, is also corresponds to the time where the unemployment rate was falling really fast, and people were wondering, is that because we're creating jobs, or is that because people are leaving the labor force? And well, we see something there, that there was a change in this ratio that was different from what we'd seen historically, and that would have been a signal to people. Okay, next slide. So what we'd want to do is show these for show the racial disparities in our labor market. It's just one example of the information that we can pull out of this. So you see on the top, we have the exact same thing, but we just have white up there, and then
yeah, just to jump in for a second, Scott, we are just reporting what's on the survey. So the survey
yes.
still asks the question, not African American or Caucasian American. It says white and black.
Well, that's a good question. Yes.
Yeah. No,
Yes,
that's what,
African Americans and
right. So this is self-reported. So
yes.
we're not trying to provoke anybody
Exactly.
with any
Yes,
sort of racial.
It's the survey.
This is what it says on the survey
Yes.
still.
Now, the core point here, of course, is that we have significant stratification in the labor market, that African Americans do not experience the same labor market as white people, as whites. So, okay, let's move on in the interest of time. So some conclusions. So again, not enough job openings historically, even when the unemployment rate is historically low. The officially unemployed pool is not where the major source of employers hiring. It's only about 20% at best. A better indicator tells us that our best performance since '98 is having about 31% of those that want work able to find it. And our best performance since 2000 is about 2.66 people want work or more work per job opening. And this same methodology is showing us that there are serious stratifications, especially by race in labor markets. So again, this is a material that's coming out soon as well in report form. So that's all I have.
Super. All right. That is super interesting. And please, if you have questions about this, type them in the chat box. We're going to move on to and then we'll have Q&A, additional Q&A at the end. So we're going to move on to the Green New Deal. So Dr. Fadl, if you could turn on your video, and then Scott, if you can turn off your video.
Oh.
Welcome to Dr. Fadl Kabood, and who's both professor of economics at Denison and the president of the Global Institute for Sustainable Prosperity. So you've seen, we make good products, but our companies are not that, and industries are not that green, and more people want jobs and jobs are available. So what can we do about it?
Well, thank you, Paul, and thank you, Scott. I would like to start by reiterating what Scott said in terms of the research team behind this project. I'd like to thank Amir Khaligi and Jordan Ayala and Kyle Moore for doing a fantastic work on this project, and we'll continue producing this kind of data in the months to come. So the idea here is to talk about the Green New Deal and how do we transform the economy. Number one is we need a better metric, which is what we're trying to do with the HIP scores, trying to match them with the kinds of jobs that we're creating. And we need to do better in terms of enforcing and standardizing reporting across industries. And number two, start nudging the economy, moving the economy towards greener jobs as opposed to browner jobs. So the Green New Deal framework, many people are familiar with it, but if I were to summarize it in kind of two focal points, number one, it's to decarbonize the economy. And in that process, create millions of greener jobs to transform the energy and transportation housing system into a green infrastructure. Number two is to address structural weaknesses in the economy, and that is primarily in terms of inequality of wealth and income. So these are kind of the two areas. The thing is, what we have is essentially we have the planet is on fire. We have millions of people in this country around the world who want to work, and we have increasingly more efficient and cheaper green tech innovations that will allow us to do it. And we are sitting around and saying, well, we don't know how to do it. We don't know how to pay for it, right? And I'm going to address this question. How do we pay for this massive structural transformation of the US economy? So first, what is the Green New Deal? Number one, it's federally funded. I'd like to emphasize this. This is not going to be a burden on states and municipalities. It's locally implemented, so it's a decentralized program. It has to be urban and rural. We have to create jobs like we did during the Great Depression with the New Deal. The original New Deal was implemented in every congressional district. And it has to be inclusive, it has to be just, it has to be restorative. And I'll emphasize here the stratification data that Scott just showed us just a couple of minutes ago. When you look at the labor market conditions for African Americans in this economy, you would imagine that the beginning of that data set was 1998 until this month. You would imagine that that's a Great Depression status quo, essentially. Just like the original New Deal also was not inclusive. We need to make sure that the Green New Deal starts to repair some of those structural inequities. And it has to be inclusive, has to be just in the sense of just transition. So we have to be able to decarbonize the economy and end the fossil fuel extractive industries, but not end the livelihood of people working in those industries. So we have to transition people, hence the importance of a job guarantee with decent wages and benefits as a guarantee, not as a haphazard kind of market solution that will maybe transition people into new jobs. And it has to be restorative in the sense of restoring the broken social fabric that we've lived with over the last 40 years, and restorative in the sense of healing the planet, healing the environment, addressing basic livelihood issues that require us to produce an environment within which we have clean air, clean water, clean soil, the basics essentially. And it has to be comprehensive and permanent. So we can't have a small scale Green New Deal, and we can't have a small scale Green New Deal that we only implement for 2 or 3 years and then go back to normal. There is no going back to normal under the system. So why a Green New Deal? As I said, we have to decarbonize the economy, and we need to build a more resilient system, economically, ecologically, more resilient, not just to financial crisis, not just to climate change, but also more resilient to pandemics. And we've seen this over the last few weeks. When we have to shut down the economy, we don't have, what this pandemic has done is really bring into sharp focus some of the key deficiencies that we have in the public health system, in the employment system, and the care system, and the supply chain system that we have. So that is the idea. To me, if I were to summarize the basic feature of the Green New Deal and the job guarantee to some extent, is that we take people as they are, where they are, and we do on-the-job paid training with the living wage and benefits. In other words, you don't tell people who are displaced, who are unemployed, you need to go get the training on your own. You need to pay for it out of pocket. You need to move to San Francisco because that's where the jobs are. So you take people as they are, where they are, and you do on-the-job paid training with living wages and benefits. And I live here in the Rust Belt in Ohio, so this is very important in terms of the kinds of socioeconomic dislocation that people have experienced over the last 30, 40 years. When we say wages and benefits, it's not sufficient to offer a job at a decent wage and kind of set people up for failure. Because if people are struggling with mental health, if people are struggling with addiction, if people are struggling with all kinds of issues, personal issues, then they may not be able to even to show up and hold on to that job. So the benefits need to include housing assistance, mental health, legal aid, soft skills, family counseling, career counseling, and more. The idea here is to allow people to thrive on the job and to reconnect with the local community on a stronger foundation. In other words, we don't give up on people. In other words, we lift everybody up to higher grounds.
90 minutes.
Next slide, please. So how are we going to pay for it? This is the endless question that you hear all the time. People say, we're taxed enough already. The government doesn't have money. We're broke. Even President Obama said the credit card is maxed out. And then you hear people saying the national debt, hyperinflation, Zimbabwe, Venezuela, all of these things, because the traditional understanding of how the federal government pays for things is the following. The government has to either tax somebody to pay for it, or the government has to borrow from somebody to pay for it. So that raises the national debt and is going to put us on a slippery slope towards bankruptcy, right? Because most people think of this from a kind of an individual personal finance perspective, thinking like a household. Next click, please. So what we're going to do is call their bluff. So how did we pay for World War II? The most expensive program in the history of the federal government, probably up until the last couple of weeks. We'll see how far we'll go with this one. Remember the Great Depression? It came right before World War II. It was the most miserable time in US history. There was no money to be taxed. There was no money to be borrowed. So was World War II affordable for the US? I mean, if we had this fiscally conservative standpoint, we wouldn't have entered the war. We wouldn't have won the war. Would we speak in German today? So, how about today? How are we paying for the CARES Act? Who did we tax 3 weeks ago to pay for the CARES Act? Who did we borrow from? Clearly nobody. So at the federal level, it turns out, and this is not exclusive to major wars or to the CARES Act, this is how the federal government always pays for things. You have 535 lawmakers in Washington, D.C. who get together and say, this is a national priority. They vote and approve it, and Congress has an appropriations process. And that's how the spending happens. It's not connected to taxing a particular thing or borrowing from a particular individual.
And Fadl,
So, yes,
does this require a sovereign currency? Do you need to control your own currency in order to pay for it?
Yes, so I'm speaking here exclusively about the United States, and some people know some of my work on developing countries, so I will not address that here. But to summarize, a country like the United States, like Japan, like the UK, like Canada, these are countries that have full monetary sovereignty. In other words, they issue their own currency, they tax their population in the same national currency, and they never borrow and promise to pay back in a foreign currency. In other words, the entire US debt is denominated in US dollars, not in foreign currencies. And also we float the currency. In other words, the exchange rate is not, the US dollar is not fixed to gold or silver or any foreign currency. So we have a flexible exchange rate. If you have that, then you have a high degree of monetary sovereignty, which means the federal government can spend on all the national priorities. And then I'll talk about the role of taxations in a little bit. But the point is, there was no taxes raised before the war. There was no borrowing happening before the war. There were taxes during the war and after the war. There were taxes, there was borrowing, quote unquote, borrowing that happened during the war and after the war, but it wasn't for the purpose of paying for the war. So what MMT lays out here, modern monetary theory, is that sovereign governments decouple the spending from taxing. So what Congress enjoys in the United States is what we call the power of the purse. So government budget at the federal level is not the same as a household budget. Whereas you and I, individuals, we have to work hard, earn an income first in order to spend. And if we want to spend beyond our income, we have to borrow from a bank or borrow from a friend. And now we have a financial burden. We have a debt that we must pay off eventually. The only way to pay it off as an individual is to work harder, earn more income, or spend less or do both. The same is true for states and municipalities. The same is true for a business. But the federal government is not the same thing as a household or as an individual, as a business. So government spending, in other words, is not constrained by so-called tax revenues. What constrains federal government spending is the risk of inflation. So if we put too much spending in the economy to the point where we have so much demand for goods and services that we exceed the productive capacity, then we have inflation. So one problem that we may face is not enough productive capacity to meet the new demand. And the good news about this is that we can increase the productive capacity. We can produce more good paying jobs to boost productive capacity. The second component that leads to inflation is when you have, powerful price setters in particular industries who can raise prices just because they can. And this is, I'm adding corruption here, because when you think of big pharma, the reason why they raise drug prices without with impunity is because we let them, is because we have people in Congress who let them get away with it. So there's a room here for regulation to address this kind of inflationary pressure. Next, please. Okay. So we're talking about a paradigm shift in terms of how we address, public expenditure at the federal level. So what about taxes? So number one, we're decoupling spending from taxation at the federal level. Spend on national priorities, on public health, on education, on green infrastructure, or whatever we as a democratic society set as a priority. Number two, we focus spending to increase and improve productive capacity in strategic areas. Then we focus taxation on taxing pollution, not because we need their money or their permission to fund the Green New Deal, but we tax pollution because we want to decarbonize. You tax speculation on Wall Street because we want financial stability, not because we need their money or their permission for education. You tax extreme wealth, not because we need their money or their permission to fund public health, but because we want to reduce inequality, because we want to reduce their power and influence in politics. In other words, we want to protect democracy from an oligarchy. So MMT shifts the conversation completely about what is possible in terms of national priorities and why we tax for what purpose. So it's not taxing to raise revenues. And then the role of the government in terms of regulating markets is to regulate to reduce market power, to reduce price setting behavior, and to make markets more competitive. So now we regulate and we put in place a system that allows us to pre-distribute wealth so that the economy is producing the right outcomes to begin with. So we produce less pollution, less inequality, less socioeconomic exclusion, as opposed to the old narrative that says, oh, we have to tax extreme wealth so we can redistribute to those who are, not fortunate enough to get the jobs or to get the good quality jobs. So from an MMT perspective, you don't have to redistribute, you pre-distribute in the right way from the beginning. Next slide, please. So hashtag goals. So what are the national priorities? First, universal public services, investment in green infrastructure, universal health, education, pre-K, childcare, whatever we as a democratic society decide these are the national priorities. And I think a country like the United States, number one, can definitely afford this. Number two, badly needs some of these services. And again, the pandemic has revealed how unprepared we are in terms of dealing with these kinds of shocks. Number two, a federal job guarantee with the living wage and benefits for people who want to work, for people who can't find employment in the private sector, the nonprofit sector, or the mainline government sector. And the numbers that Scott and his team just showed us reveal, a completely different narrative from what you've seen in the news in the last 2 years. The last 2 years, everything you see in the mainstream media is telling us we're at full employment. We have way more job openings than number of people unemployed. And the data that we just revealed is showing us that we're not even close to satisfying the number of people who really want to work. And these numbers are going to explode in the next couple of reports, as everybody expects. And then number three, we provide a generous income support for people who cannot or should not work. So some people refer to this as universal basic income. I'm very careful here not calling it universal. We're talking about people who can find employment in the private sector, people who for health reasons or family reasons can't take jobs in the job guarantee system. And in terms of once you build this kind of resilience in the system, when you have a pandemic, then you can immediately fall into this infrastructure that allows us, a safety net for everybody, regardless of who they are, regardless of their background, regardless of their skills. We have a resilient safety net that protects everybody. Can we afford this? And this is a rhetorical question. If you could pass the next slides. Can we afford these situations where people are literally dying, not having access to clean water? These are pictures from Pennsylvania. Can we afford these forest fires in California? Can we afford the flood waters in the Midwest? This is about shifting the narrative. And in a sense, what we're trying to do with this Green Jobs Report and a bunch of the work that we're doing at GISP with the UMKC team and with HIP Investor is to build a dashboard of alternative indicators to shift the narrative, to focus our attention on things that matter. So on the next slide, if you look at this, this is, GDP is what everybody's obsessed with. Everybody's obsessed with economic growth. What we want to do is look at something like the genuine progress indicator, which is, to me, is like the closest cousin to GDP, because it starts with the GDP numbers and then it strips GDP from all the negative stuff. So for example, every time we drink water from a polluted water source, we pollute the air and we breathe that air. We have illnesses, we have cancer, we go pay for medical bills and cancer treatment. All of those spending, all that spending that we do on the negative effects of pollution show up in GDP as positive numbers. When we put people in prison, build more prisons, GDP goes up. It gets celebrated on TV as economic growth. But does that improve quality of life? So GPI takes all of those negative things out. And if you notice the data for the last several decades, GPI, in other words, quality of life in the United States has been flat, whereas GDP is growing. So if you click
Fadel,
next,
how does this relate to like sustainable development goals or UN's 2030 agenda? Are those similar direction?
Intuitively in the same direction, but in terms of how they're measured, they're slightly different. Right? That's the short answer. So what we want is, if you click next, we want to change the narrative. We want to focus on the things that matter. So for example, if we build this dashboard of alternative indicators and we change the metric, which is what we're trying to do with this project, then you turn to policymakers with these color-coded pictures and say, is this what you want? In other words, would we rather invest in after-school programs to inspire kids with music and theater and summer camps and things like that? Or say, no, that's too expensive, we can't afford it. Instead, 15 years later, we build a prison for them and we treat it as a solution. Instead of cleaning the water source and creating the green jobs and stopping the fracking, we say, no, we can't afford to do that. And instead pay for everybody's cancer treatment for the next 30 years. Right? So shifting the narrative so that we can reorient public policy in the right direction. And to conclude, we have 10 years to go. The clock is ticking. 10 years not to think, but 10 years to act on a massive scale. The climate crisis, the inequality crisis, the poverty, socioeconomic exclusion, all of these things call for bold and transformative actions, not slow and gradual and incremental action. So currently, the climate policies we have, the jobs policies we have are too weak, too slow, too expensive, and they don't even work. So economic justice and climate justice via living wage Green New Deal are possible, desirable, and affordable. This Green Jobs Report that we're laying out today essentially provides a new framework for a metric to effectively guide strategic investments to reorient public policy decisions. And finally, I'll transition directly into my colleague's presentation, Pavlina Cherneva's presentation on the job guarantee. And as you'll hear from Pavlina, the job guarantee is not a nice add-on to the Green New Deal. The job guarantee is a core feature of the Green New Deal. So with that, I'll transition to Pavlina's presentation.
Great. Well, thank you, Dr. Fadel. We have additional questions that we'll answer before we wrap up today. Dr. Pavlina, please turn on your video, and Dr. Fadel, turn yours, and then cue this up right here. So welcome, great to have you here. And please tell us about how the job guarantee works. And this is part of your new book too, right? You have a new book coming out in the summer?
Yes, it's coming out in June, 26th of June. It's called The Case for a Job Guarantee. And thank you for having me.
Sure.
It's good to be here. So just to pick off from where Fidel left off, let me just get my slides. Okay. The job guarantee was called the single most crucial aspect of the Green New Deal. And I think that the climate activists got it right and clearly articulated the core message in the Paris Accord that, you know, we really cannot have climate transition, climate justice without economic justice. And economic justice is also centered around basic human and economic rights, including the imperative of a just transition of the workforce and the creation of decent work and quality jobs. And so, you know, the climate activists said, no, there isn't a trade-off between climate and jobs, which was one of the hurdles and the obstacles that I think that we have experienced for quite some time before the global community coalesced around these bold, big proposals for a Green New Deal. And so just to touch on some of the arguments that were made, you know, there aren't really purely technological solution, as your project, Paul, is recognizing, and all the research that you guys are doing, that, you know, you can't just put in place a technical solution to clean water or, you know, dirty water, or to some environmental problems without having some very direct and concrete implications on social life, economic life, on specific communities. And so the questions that we want to be asking is, what environmental policy do we want? What kind of social implication is it going to have? And if we weatherize our homes, are we going to still have hundreds of millions of people sleeping on the streets? And if we transition the transportation system to, you know, with renewable energy, will people be able to buy a Metro card? You know, will we produce food with sustainable practices, but still have people who cannot afford it? So economic security is sort of the key component of that broad agenda, and the job guarantee is a policy that delivers that economic security in one very particular aspect, by guaranteeing a decent living wage job. And so if we could go to the next slide, at least in the Green New Deal resolution, the call to guarantee a job with a family sustainable wage, including adequate family and medical leave, paid vacations, retirement security to all people in the United States, was front and center. And in specifically, sorry, you can just go to all the bullet points, because I think that's right, thank you. Specifically, the job guarantee proposal is saying that at this point in time, at a minimum, that guarantee of a job must include $15 an hour. In this proposal, and there are a number of proposals out there, Medicare is also a key component of the job guarantee, as well as professionalized childcare for workers in the program. So how shall we think about the job guarantee? It is a public option for jobs, and it's not just an add-on to the green agenda that will help folks transition from their fossil fuel jobs to, you know, some green jobs, but it is actually a broad structural reform, economic reform. And I'm going to talk a little bit about those features. But what I think the job guarantee does is asks a very basic and fundamental question. Why have we accepted, if we can go back one slide, why have we accepted a world of unemployment? Now, I think if we prod deeper, even into our sort of subconsciousness, I think that there is this tacit agreement that unemployment is unfortunately inevitable. That, you know, maybe there's not all that much that one can do about that. And, you know, perhaps we can create some jobs, and there would be some jobs projects, but unemployment is going to be a fact of life. And the job guarantee is basically a rejection of this kind of philosophy. And so it is a paradigm shift to call people to envision a world in which we both protect jobs, like in the current pandemic, putting in place policies that protect payrolls at all costs, but also create jobs rather than accept the fact that unemployment is going to explode. And so it is a public option for jobs that guarantees that whoever walks into the unemployment office can walk out with this very basic, decent job that provides decent wages and benefits. So it's an employment safety net, but it's also a transitional job opportunity. If you happen to be in unemployment, you transition into employment. If you happen to be into precarious employment, then you transition into stable employment. And then, of course, the job guarantee has the strong sort of placement component that Fidel discussed. So on the next slide,
question,
yes.
Just quick question, because there's a clarifying question from the audience here. For people like home caretakers or artists or creative work, are they part of this? How should it be compensated?
So this is a job guarantee for people who go and seek work. As Fidel stressed, it's situated in a broader agenda that provides economic security. So there are some home caretakers that cannot and should not be required to work for their benefits. And it's very important to point out that the job guarantee is not workfare. It does not ask people to work in exchange for benefits. So it is situated within a broader agenda that provides income support for those who cannot and should not work for whatever reason. But there are caretakers who will appreciate help with socialization of the care work. And God knows we have so many neglected areas and so much care work that needs to be done, both for elderly, for at-risk youth, for universal childcare is one component of the job guarantee, and you can tap into it whether you work in the job guarantee or whether you're employed elsewhere. So it is a public option for care, if you will. But there are caretakers that want to transition to paid work, and they have enormous obstacles to employment. And there's really good research that actually a stay-at-home parent has greater obstacles to employment than an unemployed parent. And so the job guarantee is really that stepping stone for people at all walks of life. And as I'll talk in a moment, it does enhance the public good. So absolutely, we're giving jobs to the artists and the musicians if they need them. But before I get to that, I want to go on the next slide, because this is a picture everybody has seen the picture. If you've looked at the unemployment official unemployment rate, you've seen this picture. And even though this is such a narrow definition, the official unemployment rate, as Scott explained, is such a narrow picture of the unemployment situation. What is stunning to me is how we have accepted the way it behaves, how we have accepted this idea that when the economy turns into a recession, these gray shaded areas, we lay off people in mass. There is an avalanche of job losses. And that has once again become one of those unexamined, stylized facts of our reality. And then it takes a very long time to bring some of those jobs. And as Scott explained, we don't really create ever enough employment opportunities for those who need them. And now that St. Louis Fed is forecasting 32% unemployment rate, which we have not even seen in the Great Depression, and the scourge of unemployment means one thing. One epidemic is going to be followed by another. It's going to be followed by the social catastrophe that comes with mass unemployment. And so when I wrote the book, and this is the next slide, I actually sent it to press before the pandemic. It went to the publisher at the beginning of March, and we can show all the bullet points because I think they're out of order again. But one of the main arguments that I made in that book was that even in the best of economic times, even in expansions, unemployment has this very clear features of quiet and silent epidemic. So as we slide into a downturn, if you look at just the local area unemployment statistics by the BLS, you see how unemployment truly ripples from community to community to community. So if you watch how it evolves through time, and from these communities, it's it does behave like a virus. You know, if you look at epidemiological models of how the virus spreads, well, that's how unemployment spreads. Because in a way, you know, when there's mass layoffs, those affect, you know, neighboring communities, supply chain, additional jobs that are connected to the initial mass layoffs. And so you see that initial burst of mass layoffs throughout in a kind of this geographical sense. But also unemployment brings enormous social costs, and these have been very well documented. And they actually make our communities sicker. They make the unemployed sicker. They make their families, their children weaker, in the sense of poorer performance in schools, poorer health outcomes. So unemployment is also a public health problem. And so the argument that I made in the book, and now I think that the sort of the epidemic, the silent epidemic of unemployment is truly going to become a pandemic of social problems, is that we just should reject that very notion that this is an unavoidable circumstance, and we have to treat unemployment the way we were supposed to treat these extraordinary epidemics or pandemics. And so I even used the example of the National Strategic Stockpile, of how we have designed a system which unfortunately malfunctions at this moment, but was designed precisely for the purpose of distributing medication on demand, supplies, PPEs, masks, in these extraordinary circumstances. So now imagine that we put together a policy that used, instead of the strategic stockpile that are scattered through the country, used the unemployment offices. And we made those unemployment offices, we made them green jobs banks. They would be tasked with soliciting projects from the community, green projects from the community, and they will become repositories of jobs projects. So that whenever we have mass layoffs in a community, or even if we don't have mass layoffs, even if in good times, folks that are struggling to find good jobs are looking for employment, then they can just go to the unemployment office and they can go to the Green Jobs Bank and then look at a menu of options of green initiatives that then have been proposed, that are sort of the proverbial on-the-shelf jobs. And then we fit, as Fadel was saying, we fit people and we fit the jobs to people, to their needs, to their skills. We also enhance the program with various training, credentialing services. And so it is a comprehensive approach to job creation, but also connecting people to wraparound services and helping them deal with all of the other obstacles to good, decent employment. And so, in a sense, we have two choices in front of us. We can either accept the status quo, which means guaranteed unemployment, or we can accept an alternative, which would be a policy, a vision of a public safety net that guarantees employment on demand. And another very important macroeconomic reason why this is important is because we have become so accustomed to unemployment as a perennial feature of the economy that we now call it natural. And in fact, we design macroeconomic policy around particular positive level of unemployment. And so, you know, folks who have heard me talk about this, you know that the NAIRU is this one concept that is used as a policy guide by the Federal Reserve in assessing whether we need to add quote unquote stimulus or we need to step on the brakes. And the NAIRU, unfortunately, is this concept that is theoretically, methodologically, I think empirically very dubious, and it has been used as a justification for mass unemployment. And only in February, we were arguing, and I think economists begrudgingly admitted that we don't know what the NAIRU is. Of course, there's a lot more labor market slack. I mean, if you're listening to Scott's research team, you would have known this already, that there's plenty of labor market slack. And so the job guarantee says, no, we will not be stabilizing the economy on the backs of the unemployed. If for
Elena, two questions, well, three questions. One, the NAIRU is what?
Oh, it is another word for natural unemployment rate, but it is it stands for the non-accelerating inflation rate of unemployment. Very clunky, cumbersome economic term that says that you know, there's a given level below which of unemployment below which we're going to see serious inflation.
Got it.
And so that's some sort of positive level of unemployment.
All right. The
But-
second question, do you see local job offerings as being ongoing until that worker is hired into the private sector or short-term jobs? So like community garden construction might have a short timeline and only last a couple days or a couple weeks, and then they rotate into another job. What's the flow of jobs and people?
So what, because it's a local program and because these are local projects, when you go to the unemployment office, you know, there will be local jobs near the place you live. But the job guarantee is a policy that is a safety net. So they will be local, yes, community gardens. They will be, I'll give you some examples of some local green projects. And we see flows from, you know, different, from private to public, nonprofit sector at all times. So the job guarantee is not going to be necessarily different than what we're already seeing in other parts of the economy. As people wish to transition into other better paid employment, as they train and get new credentials and seek greener pastures, so to speak, then of course the job guarantee office will help them transition to those opportunities.
Okay.
So, yeah.
So then people can choose whether they want those types of opportunities or another job opportunity, and they might be paid differently, or they might have different flex hours. Is that part of the decision-making by a potential worker?
Yes, in this proposal, we are guaranteeing a basic job offer. And but basic job offer, we also mean a decent job offer with decent pay and decent benefits. So that becomes the standard for the economy as a whole. And that is the, you know, one of the features of this program, that if folks have the option to work at 15 an hour with Medicare and with some basic benefits, then that really creates a floor and a pressure on poverty paying firms and private employers to meet the standard.
Right.
And in that sense, we are formalizing from the bottom up as it becomes a structural reform of the labor market. And we are formalizing from the bottom up private sector jobs as well. And then people can transition to these other employment opportunities. But I will, in the Green New Deal, there are 3 different ways in which we talk about job guaranteed jobs. So I want to transition to that slide to explain what the difference is.
Great.
Okay. Oh, okay. This were some of the examples. So, you know, we can definitely talk more about these in the Q&A, but when you think of projects like green projects, you can think of, you know, sort of a modern, you know, tree army, if you will, using trees as urban architecture, looking at soil erosion efforts, you know, all of these environmental monitoring surveys and fire prevention, all the things that Fidel was mentioning. I mean, these are neglected areas that require some very serious investments that are not undertaken by the private sector at a rate that needs to be, you know, the work needs to be accomplished. So this is part of the public service job and part of the job guarantee. We do also need, you know, community gardens, you know, recycling initiatives, care for people, as I said, at-risk youth, outreach programs, etc. Now, and of course, we also need a pandemic response, and we could talk about that in the Q&A as well. But even today, as we're shuttering down the various sectors, we have a lot more jobs that still need to, a lot of jobs that need to be done that are unfilled. So what are the 3 job guarantees in the Green New Deal? Because the Green New Deal is a comprehensive approach to the climate crisis. There are 3 different types of, I think, guarantees. One of them is the guarantee that we will do the mobilization, that we will do the wartime level investment that is necessary to address the climate crisis, and that is the all hands on deck. This will take the form of all manner of public investment all manner of public-private partnerships, if you will, of technological know-how, and other programs where government leads, where the government provides the funding. The second guarantee is to the fossil fuel workers. That, you know, there have been people that have been toiling away in these sectors for years. They're bearing the health brunt. They also now are experiencing the job loss with the loss of manufacturing and the decline in these some of these extractive jobs. And so we have a promise to, you know, we have a sort of obligation to them to provide them with a security, economic security, as we shut down completely these extractive jobs. And that can take the form, again, in the form of either other union paying jobs, well-paying jobs. In other industries, some may be able to transition into the green world, others might not. And that guarantee will be in the form of early retirement, generous income support for those who cannot or will not, you know, we cannot demand of them to be working. And the final is the macroeconomic structural reform and the new social contract that I articulated, that even if we have managed to stabilize emissions, even when, hopefully when, not if, we have moved to these more sustainable practices and we have transformed agriculture and transportation and the production system, that we cannot honorably discharge the job guarantee so long as we still have an economy that has cyclical variations. People will be losing their employment as a consequence just of the heartbeat of the economy. And that will be a green economy, but it likely will still be a cyclical economy. And we cannot allow unemployment to continue to be the collateral damage of that heartbeat, of that cyclical variation. And so this is really the component, the job guarantee component, that is a permanent macroeconomic structural reform that replaces unemployment with guaranteed employment at all times, good or bad. And I'm just going to conclude with the fact that now is the time, that these policies are very popular. They have garnered a lot of support, and there are many surveys that were done. You can click one more time to see the actual poll results. But you know, these are not pie in the sky policies. And in fact, the job guarantee has been polled for a very long time. Now at this moment, it has garnered probably the most support that I have ever seen, but it usually polls above 60%. Even since the 80s, the various surveys have looked at, have polled the popularity. The Green New Deal is very popular. And the Green New Deal resolution has garnered considerable support from senators and representatives. And I think that this is the moment where we need sort of the political mobilization to make this happen and extract these promises from our policymakers. And if we don't do it now, then when? Thank you.
This is fantastic, Dr. Pavlina. Thanks very much. It's great to see the support. Any short answer to the senators and representatives or the candidates? Are they part of one party? Is this bipartisan? What's the mix?
Well, there is, in terms of the support for the components of the Green New Deal, bipartisan support. The job guarantee in particular garners the most bipartisan support if you separate it by conservative, leaning conservative, very conservative, and very liberal. Now, the Green New Deal resolution primarily has had signatories from Democrats, but there are some Republican mayors, for example, who are attempting green projects on local basis and are understanding the benefits that come with the green transition. And of course, we have many organizations and candidates who are running for office that have taken on the Green New Deal. So I think that you know, having a good job, a decent job is not a partisan issue. You know, a family sustaining wage, you know, cuts across, and it resonates. And, you know, I think that we got to seize the moment.
Super. Well, thanks for all your work on the case for a job guarantee and the job guarantee itself, and for engaging on policy and policy advocacy. We're gonna wrap up here since we're just about at time, and feel free to email in your questions. I'm gonna go back over here so Nigel can wrap up on good news.
Fantastic. Thank you very much, Paul. And just a couple of observations. You know, we have been talking and thinking about these issues for 50 years. A huge amount of work has been done. There are many solutions on which we can act. We don't necessarily need to find the very best one. Simply acting at all will be a good thing. We have seen through those 50 years that there is rampant short-termism, and that's bad for the environment. It's bad for people. It's bad for investment too, as HIP Investor has shown through its analysis. So before coming to the good news, one thing I wanted to say was, it's good to think about, you know, why has change not happened? Change has not happened partly because the vested interests are enormously well connected, very well funded, and have very powerful voices. There are all sorts of industries where there are structures which just prevent change. So the person that paints the hull on the ship is not the person that pays the fuel bill when you rent the ship. So you have to find ways through that. And also, people are relentlessly focused on the short term, and some of these things take time to happen. The fundamental thing here is we must all act, and there are ways we can do so. And that is the segue to the good news. And we have 3 bits of good news here, 2 pictures, but 3 bits of good news. The first is green investment, and this is driven purely by rational economics, remains very strong. These are the figures for last year, global investment in renewable energy. And the second bit of good news is this continues. You know, we in our business in Australia, which is one of the countries where there is more solar radiation and higher power costs than almost anywhere else in the world. We continue to close deals in solar energy. There is an explosion of interest in corporates buying renewable energy, which dramatically helps find power purchase agreements and allows all this to be driven by bottom line thinking rather than anything else, which is tremendously helpful. And thirdly, there are good books which set out what to do. Pavlina's book is here. When it arrives, you know, buy it before it's been published if you can. Sign up for that. Just looking ahead very briefly to tomorrow, we have Imam Asad Zaman, the executive director and imam of the Muslim American Society for Minnesota, Rabbi Abraham Unger, professor and director of urban programs at Wagner College, and Dr. Eutimio Tiliakos, the secretary general of the Fondazione Centesimus Annus Pro Pontifice. Excuse my pronunciation, I have no Italian blood. And to end, I think simply to say thank you very much to Scott and Fadel and Pavlina. There has been a huge amount of material for us all to absorb. We will provide links to the recordings afterwards. There will be further resources on the webpage for this discussion today. And my personal thank you for joining Paul Herman and myself, Nigel Lake, on ESGX Live, our community for education, inspiration, and once again, action. Thank you.